Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger here on the sidelines of the Kansas City Federal Reserve's annual economic symposium, joined by Philadelphia Fed President Patrick Harker. President Harker, thank you so much for joining me.
Thanks for having me.
So a couple weeks ago, you were of the mindset that the Fed may be near the point it could hold rates at current levels. Is that still your thinking here?
At this point, yes, although the data will dictate in the next few weeks what we do in September, and I have to be open to that. But I want to recognize that, first, people often think that we have different ends in means when it comes to the FOMC. We don't. We all want to get to the same place, 2% inflation. It's just a question of how to get there. For me, putting pressure on the economy, which we've done, I think we're in a restrictive stance, and keeping that pressure on is, from a risk balance perspective, to me, the right thing to do. Now, others may disagree with that, but I think at this point, just let things work through the economy. And I'm hearing this from a lot of my contacts. What I heard time after time, I was out in my district a lot this summer, and they all said, look, you've done a lot very quickly. Let us absorb that. Let us figure out, as bankers, what that means with respect to our loans and whether we're gonna issue more or not. Companies, whether they're going to make the investment or not, et cetera. So I think we need to give it a little bit of time, but recognize that not raising rates right now still means we are in a restrictive stance. We're still putting pressure on the economy.
We're going to get a couple more inflation reports between now and your September policy meeting. We'll also get another jobs report. If the data continue to show a cooling trend in line with what we've seen on the past couple of reports, would you be in favor of moving into an extended hold at the September meeting? Yeah,
possibly. Yeah, I think at this point, that's where I am. If things change with those reports, if we're not seeing the kind of cooling, or if we see reacceleration, which I really don't see right now, then I may change my mind. But right now, I'd like to hold and see how things turn out.
And how long do you see holding rates at these extended levels, right? Because the market thinks that you guys are going to start cutting in the middle of next year. Yeah. Is this more of a longer term phenomenon towards Q4?
Yeah, so we clearly are going to hold through the end of the year, right? Next year, we need to let the data dictate that, right? We need to see what's going to happen.
How are you viewing the bond market now? Because Treasury yields have surged to their highest levels since pre-financial crisis. I'm curious how you factor that into setting interest rates. And in some ways, is the bond market doing your work for you?
Yeah, so obviously the long end of the curve, there are a lot of factors, not just monetary policy that affect that. There are global factors that affect the long end of the curve. We just affect the short end of the curve. But yeah, it's doing some of the work for us for sure.
And given that we're seeing nominal yields bump up above 4.25 this morning, real yields bumping up to around 2%. If we were to see real yields get above 2%, is that going to be problematic for the Fed? What are you targeting as far as the real funds rate?
Yeah, we don't really target the real funds rate, right? We target inflation, unemployment. And so that's not one of the things, at least I target, and I don't think we collectively target. Again, if those rates were to increase, they will have clearly an effect on the economy, and that effect could be good or bad, depending.
Once you get to the certain level where you're going to hold rates for an extended period, as inflation continues to fall, how will you determine whether the policy rate has become overly restrictive and needs to be trimmed?
Yeah, we need to see clear signs we're moving toward 2%. Now, our view is we're going to get under 4 this year, under 3 next year, and in 2025 we'll hit 2. It's going to take some time. And I think we just need to be ready for that. It's going to take some time. That said, what I am really listening to is not just the data, the inflation data we get, but the soft data. What I'm hearing from my contacts throughout my district, and what I'm hearing from them is things may be, and I emphasize may, softening more than the data show. In that case, we'd have to react accordingly. But really, we need to see that play through the inflation data before I would be willing to take us off the hold.
How much longer do you think this economic cycle of growth can play out? I mean, no one canceled the business cycle, right? But the economy has remained so resilient in the face of your 11 rate hikes. But as you said, some of your contacts may be seeing some softening than what the formal data are dictating.
Softening. That's the key. It's not what we're not hearing anywhere is that things are getting worse, much, much worse. They're softening. We've even seen in our recent manufacturing business outlook survey a little bit of an uptick after many negative months. So it looks like we might be, our forecast right now is that soft landing is most probable. Not it's guaranteed, right? Nothing's guaranteed. But, I think we can this is possible for the economy.
I want to ask you about the relationship between wages and inflation.
Sure.
Because wages have really remained robust, even as inflation, while still high, is coming down. How do you explain that relationship? Is it that productivity perhaps is stronger than the data put on? Is it that the relationship has changed, or merely just a lag?
Yeah, I don't think the relationship's changed. It could be lag, it could be productivity. Combination of those factors. Where it really affects the economy, in my view, is in services inflation, service X housing, right? That is where we're starting to see some signs that wages are starting to soften, which is a good thing, because that is the one area of inflation. We've seen good inflation go down. We're going to see shelter inflation come down just mechanically, right? We're seeing that happen. But the service inflation has been stubbornly high. As Chair Powell said in his speech today, it's basically gone sideways. Right. So we'd like to see that continue to come down. And I think we're going to start to see that. Part of it is there's more labor. You see this with the JOLTS data. The openings have been declining. And what we're hearing from all our contacts is it's much easier for them to hire people right now.
Okay. In terms of longer term growth, as you look out for the economy and the job market, really the dating culture has changed so that people are getting married later in life, and as a result perhaps having fewer children, which raises the question of population replacement absent proper immigration. So I'm wondering, what does that mean for longer term economic growth and job shortages too? Yeah,
that's a good question. One of my old colleagues, a very prominent demographer when I was a faculty member, would constantly remind me, demography is history. Demography drives much of the economy. It's not monetary policy, although important. Ultimately, long term, it's the population. So that's an issue for us. And there's a trade-off, right? You either get more productivity per worker or you get more workers. They're really the only two things you can do to increase growth. And in that case, immigration policy is not our business at the Fed, right? But it's clear what I hear time after time, contact after contact, is almost a pleading that some sensible immigration policy is put in place for the country. And you see this in, for example, wafer fabs are being built right now, onshore in the United States, but we don't necessarily have the talent to put the labor in there for them. So we really need to think comprehensively about, not only immigration, but also how to bring people off the sideline. The Philly Fed, we've been really focused on this with what we call the opportunity occupations approach. And we're really looking at jobs that pay above median wages that don't require a 4-year college degree. We have a tool, which is a great tool, the Occupational Mobility Explorer, where people can go in and say, with a little bit of training, what kind of job could I get in my region and what kind of increase in salary? We need to bring more people off the sideline who are sitting off the sideline, get them productively into the economy. The economy needs them. And they need to do it for their families and their communities.
Absolutely. And so what do you think this is going to mean longer term for rates? Actually, two-part question. One, are we in an era now where we're going to be seeing higher interest rates given where the economy is, given the strength of the job market? I know you expect cooling. And then two, given what we just talked about, what does that mean for the longer term for rates?
No, I think the longer term, so go back to 2019, before the pandemic. It's hard to remember what life was like then, given everything we've been through. We had low unemployment, low inflation, and trend growth. I ask myself, and I don't know the exact answer to this, but I ask myself, what's fundamentally changed in the economy, other than the demographic trends we're talking about, that would change the opportunity to go back to that situation? I think it's possible. I'm not saying it's for sure we're going to do that, but it's possible we could get back to that scenario. We've been there before. So we have a proof right there, right, that we've done it. And so I think we could possibly do that again.
To your point, I mean, the overarching theme here this year is structural shifts in the global economy. This, of course, coming off of the pandemic. I know we're early innings in the conference here yet, but having talked with colleagues, what are the takeaways? What are you hearing? What are your thoughts? I mean, to your point, the economy has changed greatly. You think we can get back to pre-pandemic? What are you hearing?
So that, again, this is the debate, I think, at the conference, right?
Yeah.
What has really shifted fundamentally? I mean, lots of things. Geopolitically, things have shifted. I mean, the horrendous situation in Ukraine, the trade tensions we have around the world, and so forth. So those things have shifted. But net, and of course, the advent of AI and other technologies, but net, how big an impact will they have on the global economy and on the U.S. economy? That's still an open question, and that's what we're debating here.
All right. Well, Patrick Harker, thank you so much for your insight. I so appreciate it. Hope to talk with you again soon.
Thanks.
That's Patrick Harker, president of the Philadelphia Federal Reserve.